Namaskar. Today, as we stand at the crucial junction in India's economic journey, it is essential to speak plainly about the pressures facing our markets and currency, especially the implications of every citizen of India. In recent weeks, global geopolitical tensions, especially a prolonged conflict in the Middle East, have sent crude oil prices sharply higher, with Brent crude trading above $110 per barrel, up nearly 50% this month alone. This surge in energy costs directly impacts India, which imports nearly 85 to 90% of its oil needs. As a result of these energy shocks and a broader risk of sentiment in global markets, the Indian rupee has weakened to a record low of around 93.9 rupees against the US dollar, surpassing all previous lows. Simultaneously, our key stock market indices have felt significant strain. On a recent trading day, the BSE Sensex fell over 2% and the National Stock Exchange Nifty 50 declined sharply, with losses widespread across all major sectors, including small and mid caps dropping even more. Behind these headline numbers lies a deeper flow of capital. Foreign portfolio investors have withdrawn nearly $9.5 billion from Indian equities since this conflict has begun, reflecting global risk aversions and repositioning of capital towards safer assets. This volatility has also rippled in our bond markets. The 10-year government bond yield climbed close to 6.8%, representing higher borrowing costs and investor caution amidst rising US yield and inflation concerns. Let us be clear. These dynamics are not isolated turbulence. They affect every Indian household and every enterprise, from higher fuel and transport costs to increased costs of capital, from pressures on exporters to tighter financial conditions for businesses who are planning expansion. Yet, our approach is grounded in sober realism and proactive policy. The Reserve Bank of India has intervened in currency markets and bond purchases to moderate this volatility, while we continue to monitor and adjust macroeconomic responses in real time. At the same time, our foreign exchange reserves remain ample, providing us resilience against sudden shocks. So let me assure you, volatility is not weakness. It is a test of resilience. India's growth, fundamentally driven by strong domestic demand, demographic dividends, and strategic policy reforms, remain intact. But we will not overlook short-term headwinds. We will address them with prudence, unity, and resolve, ensuring that stability, growth, and prosperity remain the guiding priorities of India's economic journey. That's all I would want to say. And we should focus more on maintaining our indigenous requirements currently rather than procurement. Thank you very much. Namaskar.